Welcome back to our third session. Our third session will be made up of the lesson 3. Our lesson 3 here is personal income tax, where we are going to look at different personal taxes or individual taxes. And among the individual taxes here, we can talk of, we are going to look at employment income. We are going to look at the business profit. We are going to look at the investment income, and we look at a raise or sell of business assets. These kind of incomes, the employment income, the business profit taxes, the investment income taxes, lease or sale of business assets, so on and so forth. So this personal income tax, an individual may be a resident or an ordinary in Rwanda, and his liability of Rwandan income tax will be determined accordingly. So a taxpayer's residence and ordinary residents have important consequences in establishing the tax treatment of his Rwanda and overseas income and the capital gains. So there's something very important here we are going first of all to look at. We are going to look at who is a resident person, who is a residence person. For who is a resident person in Rwanda. So according to the Article 4 of Law number 16 of 2018, an individual is considered to be a resident in Rwanda if he or she fulfills one of the following conditions. So number one condition, if he or she has a permanent establishment in Rwanda. The second point here, if he has got the habitual abode in Rwanda, that is to say, if for example he spends most of his time in Rwanda, or he can be having a lot of engagements that makes him to come to Rwanda when you're a foreigner. So if you have a lot of engagements that makes you coming to Rwanda a lot of times when you're a foreigner, so that makes you having the habitual abode. So the number 3 that makes you to be a resident person in Rwanda, so that it can be taxed, is if you are a Rwandan representing Rwanda abroad. For example, ambassadors. The ambassadors. Another thing here, if you're a non-resident, who stays, a non-resident, and you stay 183 days in Rwanda, 183 days in Rwanda during the tax period. So you are now, if you fill the conditions for you to be a resident person in Rwanda. Let's look at the tax implications of a resident person in Rwanda. So number one tax implication of a resident person in Rwanda: if you're a Rwandan resident, if you're a Rwandan resident, a Rwandan resident is taxed on both income generated in Rwanda and abroad and outside in Rwanda. So the second implication here, a resident will be taken under PIT, personal income tax, and under personal income tax, whereas a non-resident will be subject to withholding tax, will be subject to withholding tax of 15%. Look at the personal income tax rate for the individual business. The PIT rate for individual business here, the PIT rate for individual business is progressive tax. Ranging from the following. Tax bands, from the following tax bracket. So where an individual who earns between 0 to 30,000, this person will be taxed 0%. An individual who earns between 30,000 to 30,001 to 100 will be taxed 20%, while the individual income here who earns above the 100 will be taxed 30%. Here we have seen that the individual businesses can be taxed under that tax bracket, where from 0 to 30 is 0%, from 30 to 100 is 20%, above 100 is 30%, but that is the monthly. If it is annual, of course you need to multiply by 12 months so that they can be taxed annually. So therefore, that takes us to the taxation of micro and small business of individuals, And here we need to look at how the micro and small businesses pays the tax. In this case, the micro and small business, the micro and small businesses are taken under the ransom taxes. The ransom are taken under the ransom tax regimes. So we need to see this tax regime here. Tax regime. Tax regimes or types. Tax regimes or types. So under these tax types or tax regimes, we have the ransom. We have the ransom where the tax is calculated. The tax is calculated on turnover. On turnover. So while under the real tax here, under the real tax, the tax is calculated. On the profit. On the profit bracket tax base. Let us look at taxation of micro businesses here. Here, what happens here is that the annual turnover, of micro business ranges from 2 million to 12 million Rwandan francs. 2 million to 12 million Rwandan francs. So therefore, if the business is making this turnover between 2 million to 12 million, they have different turnover. They have different lump sums you need to be paying. For example, if your annual turnover, here I have annual turnover, and I have the tax, here. The annual turnover here, I say, is, for example, from 2 million Rwandan francs to 4 million. So you are supposed to pay 60,000 Rwandan francs. So if you are between 4 million to 7 million, you are supposed to pay 120,000 Rwandan francs. If you are from 7 million to 10 million, you are supposed to pay 210,000 Rwandan francs. And from 10 million to 12 million, here you are supposed to pay 300,000 Rwandan francs. See the taxation of small business. The taxation of small business. We have finished the taxation of micro business. The taxation of small business. Here it is said that the small business ranges from 12 million Rwandan francs to 20 million Rwandan francs. So the tax rate So the tax rate is the real rate. Yeah, the tax rate is 3% on the turnover, turnover or on the sales. For example, let's look at this example as I was going to give you an example. So, like X owns a business in Kigali. Below is his profit and loss statement for the year ended 31st December 2018. So here he has got, we have got a small statement here where we have the sales, which is 19,500,000 Rwandan francs. We have the cost of the sales, which is 12 millions Rwandan francs. We have the gross profit. It gives us a gross profit. Of course, when you less this one, you less this, you get 7,500,000 Rwandan francs. And we less the operating expenses, which is worth 5 million, and then you get the net profit before tax, which is 2.5 million. So we need to compute the tax. So here, this question is it's just simple. We have seen that the question is giving us the turnover of 19 million, and you have said that the small business, its turnover is between 12 million to 20 million Rwandan francs. So that means that our turnover here, and if it is between 12 million to 20 million, so that means that the tax is 3%, on the sales or on the turnover, and that gives it as the real tax. So therefore, our turnover here, is equal to 19,500,000. This one here, 19,500,000 Rwandan francs. So that means that we need to charge it 3% of the small business. So this gives us our turnover is 19,500,000 Rwandan francs. So times 3% as the rate of small businesses. So that gives me 585,000 Rwandan francs. So that is the solution of this question. It was a very short question and short solution. Let us look at, as we have said, that the PIT is composed of the employment income, business profits, investment income, lease or sale of business assets. So now let's look at, first of all, the investment income. Our investment income here is composed of, also, we look at the incomes here, like the interest income, we look at interest here, like dividend, we look at the income here like dividend income, dividend income tax. Actually, we are looking at the taxes, interest income tax. So we look at income like loyalty income tax. We look at income here like capital gain income tax, capital gain income tax. And under the interest income here, we also have to look at where this income is coming from, where this income is also coming from. It comes from also the interest. It comes from also the interest on bank deposits. Bank deposits. It also comes from the interest. It also comes from the income from financial instruments. It can also come from the deposits on guarantees. Deposits on guarantees. So this is how the investment income is structured. So now, as we have seen that among the investment income, we have different incomes. Number one income here we can talk of is the capital gain on shares. This capital gain on shares, it is an income from sale or transfer of shares. And the capital gain tax, therefore capital gain tax here is 5%. Look at the computation of tax base. The computation of capital base here. Of tax base. So, computation of tax base on capital gain on shares is when the shares have been sold, you need to show the proceeds. The proceeds on shares sold. The proceeds on shares actually. So you bring your figure, you post it here. You less cost of shares. So you also post it here, then you less it, and you get your capital gain. So you get your capital gain here. So after getting your capital gain, of course, you need to apply capital gain tax. Capital gain tax, which is 5% of capital gain. So you get your figure as capital gain tax, which is 5% of capital gain. There's another case where these shares can be sold, but there's another case where these shares can also be transferred from one person to another. So, but if these shares are transferred, of course, you need to show the market value of those shares. Therefore, the format will also be proceeds. This is tax base. The tax base again on the shares that have been transferred. So it is proceeds from transfer of shares. So you post your figures here, and then you less cost of shares transferred. Then you get your figure here, and you get the capital. You get your capital gain. So, and you apply capital gain tax which is 5% of capital gain on shares transferred. So you get it here. Exemption, because it is not always the case that the shares that have been sold or the shares that have been transferred should be taxed at the rate of 5%. There is an exemption. So, and what is this exemption? So the shares, the capital gain on shares traded on capital markets or on stock exchange, or capital markets, specifically Rwanda Stock Exchange, on secondary market. So these shares are exempted from capital gain tax. To question 1, this is solution 1 to question 1 I have sent you through your, it is in the description in this YouTube account of mine, and they're also already sent to your emails. So let us see the solution of that question that talks about the capital gain tax. Here we need to look at the computation of capital gain. And we state the date of declaration. So therefore, we need to, first of all, we need to actually show the proceeds from sale of shares, and the proceeds were 15,000. 15,000 are the shares that were sold among the 20,000 shares. So times the 450, which was the selling price, and we get 6,750,000. That is the proceeds from the sale of shares. So we less the cost of shares sold. The cost of the shares sold, of course, it is 15,000 times 300, which was the purchase cost, which gives me 4.5 million. 4.5 million. So we need to less this, and we get capital gain. We get the capital gain of 2 million. 2,250,000. So how about the tax? The tax here is gonna be, of course, the 5% times this 2,250,000, which is gonna give us the 11,500. As the tax. So therefore, the declaration rate, the declaration date, declaration here date. Declaration date here is 15th September. In other words, it is 15 days of next month. This is when these taxes should be declared. 15 days of next month, of the next month. Look at the interest income. As I've said, that interest income here is composed of different incomes. These incomes can come from different sources, like the interest on bank deposits, like interest on guarantees, and interest and income from the financial instruments, maybe when you're dealing with the trading of bonds or the debentures. So therefore, the interest income here, the tax on the interest income, the tax is 15%. So this 15%, it is 15% flat, and it is a withholding, of course, which is withholding tax. But the interest income from the government securities, such as bonds with maturity period of 3 years and above, the tax is 5%. There's an exception here. There is an exception here where the interest income from government securities with maturity from government securities such as bonds, with maturity period of 3 years and above. The tax here will be, the tax is 5%, not 15%. So here the general withholding tax of interest income is 15%, but when you are dealing with government securities that have the maturity period of 3 years and above, the tax will change from 15% to 5%. Let us see the solution of the question under the interest income. I've already emailed you that question, and it is also in the description of the YouTube account of mine. So let us see the solution.